The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. China is officially cutting rates, but its economy may still be in need of more stimulus. I talked to an analyst who just spent 2 months on the ground.
They have done the revenge shopping already post-COVID, post being let loose. My sense is that trade is over. They're really concerned about property prices.
It's Monday the 26th of June and you're watching Markets with Madison. What did these banks have in common? Goldman Sachs, JP Morgan, UBS, Bank of America and ANZ, they've all cut their China growth expectations. The world's second largest economy reopened this year, but hopes for a strong, sustained rebound are fading fast. China's economy is worth $17.7 trillion US dollars, but it was locked down for longer than most under a harsh zero-COVID policy. When it reopened this year, GDP growth looked promising, rising by 4.5% in the first quarter, with retail sales surging. Beijing is targeting a 5% GDP growth rate by the year's end, a projection the market calls conservative, but it may not be, with growth already tapering off. A more up-to-date measure of China's economy, industrial production, is showing signs of a slowdown, while the manufacturing PMI showed further contraction. Retail sales are also cooling. Its central bank, the People's Bank of China, is now cutting rates, one of few in the world going in a stimulatory direction. And China's critical property sector is on thin ice. New home prices in China's 70 major cities have been in negative territory for the best part of a year. They eked out a slim 0.1% gain in May. Investors were eyeing China as a place for positive returns this year. The Shanghai Composite is up about 5% year to date, but Hong Kong's Hang Seng Index is lower. Harbour Asset Management senior research analyst Oyvinn just spent 2 months on the ground in China, visiting more than 30 companies and consultants. He says he's never seen consumer and business sentiment there so weak. Oyvinn, welcome home. Good to see you.
Yeah, thank you so much. Yeah.
I want to ask first how the Chinese people, after what you've seen on the ground, how they feel towards authority at the moment.
Look, I think one of the big learnings on this trip is that the sentiment has changed quite a lot. But when we arrived in China, I did personally expect people to be wearing masks. I expected there to be restrictions around free movement and all that sort of jazz, and that simply wasn't the case. It was really easy to get around. In general, the people are wearing about the same sort of frequency of masks today as they did pre-COVID for pollution. So the masks are gone, and I thought that was really interesting. And look, I think pre-COVID they've really opened up quite quickly, and the consumer is out there endorsing that. But there's other sort of underlying parts of the consumer sentiment that's not too flash at the moment. Yeah.
How is the Chinese consumer feeling at the moment? Are they buying? Are they not?
They have done the revenge shopping already post-COVID, post being let loose. My sense is that trade is over. They're really concerned about property prices. Don't forget that the Chinese consumer or the Chinese household has been accustomed to 10, 15, 20% return on their properties for decades. And now they've had 2 years of negative returns, and is really restricting their confidence and their willingness to get out there and spend on expensive travel, expensive proteins, expensive fashion, all that sort of things are being restricted at the moment because they are concerned about their balance sheets. The cost of education and healthcare are really weighing on sentiment at the moment.
Before you went to China, were you in the camp that their reopening was going to absolutely go off, or were you less bullish than that heading in?
I personally was really expecting good things for the Chinese economy and the Chinese consumer coming out of COVID. They've been locked down longer than most. They have extremely strong balance sheets, so if they wanted to, they could actually spend more than most of us. Chinese household saving is extraordinary. So I expected that trade to be on for a lot longer and the consumer to really come back in force. But something has completely broken that sentiment in sort of March, April, when it ran out of steam, the consumer spending. So it's quite different from what we expected prior to going there, for sure.
Your outlook has changed, I imagine?
No, it has. The circuit breaker to get the consumer back spending is not easy to see. I think it's a challenging policy problem for Beijing as well. How do they get the consumer confident enough to start invigorating the consumer part of the economy, which is massive? You need that for healthy growth in the Chinese economy. And at this point in time, it is not that certain how that's going to happen. And we know that Beijing does not want property to go really strong again. They've spent years trying to dampen the property sector. They don't want to let that run hard again. So it's going to be a really carefully orchestrated policy maneuver in the time ahead.
The People's Bank of China has taken some small, I guess you could say, stimulatory action. Do you think that's enough? Will they need to do more to stimulate more GDP growth locally?
Yeah, I think what we've seen now is really the early stages of easing. They've eased the deposit rates just a little bit by 10 basis points, and they've decreased the repo lending rates just a little bit again for the wholesale market. But we haven't really seen that flow on to cheaper borrowing costs for corporates and consumers yet. So we're still waiting for that to happen, and I think there's a realistic expectation for that to happen now that the PBOC has started that chain of policy making. And the market is now expecting that to come sooner rather than later. But it's probably not going to be a huge magnitude yet, and it's probably not going to change consumer sentiment overnight. The consumer probably needs 30, 40, 50 basis points of easing, not just 10, to start feeling the cash flows start to ease and their borrowing costs coming down. So it's probably a bit of wait and see, but at least the intention of the PBOC has changed from restrictive and not doing anything to now being more accommodative and easing.
How much of that, though, do you think could just be them signalling to the rest of the world, especially to investors, that this is a place where growth is going to happen and we're going to make sure that it is?
Yeah, look, I think it's a careful balancing act that they have to strike. But, and I think the external sentiment of China, as we've seen in recent downgrades by the big global banks, is that people are aware of some of the structural challenges in the economy and some of the cyclical near-term drags where the growth out of COVID hasn't been as strong as expected. So they're faced with a point in time right now where they probably need to do something reasonably assertive to get both external forces and internal demand at ease of what's to come next. So I think the scene setting right now is getting ready for policy stimulus, both monetary and fiscal.
I guess if the sentiment currently, as you say, is so low, then any stimulatory action from here could be a real rush for China, right? So because things are so poor at the moment, does this actually then make your outlook potentially positive?
I think that's a great question, and it's probably the primary takeaway from this trip is that in the short term, sentiment can't get much worse. The consumer is really concerned about the outlook, both regarding the cost of living and the property sector. Corporates are really also very cautious and have low sentiment. Their profit margins are skinny, and they too think the demand that everyone expected out of COVID to be high hasn't quite delivered. So there's sort of pessimism across the whole value chain that easily could respond quite quickly to targeted stimulus. And at least for the local companies, like at least in Australia, across the iron ore sector, we did go and see steel mills and steel traders, and their inventories are really low. They've been losing money for over a year now, and the margins are generally negative. And because of that, they've reduced their inventories of iron ore to next to nothing. We're talking 5-6 days worth of inventory.
Wow.
Yeah, exactly.
It's nothing.
No, it's
not
nothing.
in China's property construction sector.
And you get some stimulus or a meaningful announcement, there's probably going to be a rush to cover some of that shortfall in inventories and thereby seeing iron ore prices going up. Some of that has happened actually in the last 2 weeks since we came back. So there is a sense now that people are starting to protect their inventory positions a bit and the prices are coming up. But if there's a proper stimulus program coming, then that could again benefit the resources sector in Australasia at least.
Beijing reckons that they're going to get at least 5% GDP growth this year for 2023. Do you think they can do it, or is your forecast lower?
Look, I think that target probably isn't all too stretched, but it's fair to say that the demand in the economy has been a lot worse in the June quarter to date. So since March has been a lot softer, the industrial side of the economy. And the reason that the retail sales are looking so strong, 20%, well actually I think it's down to 12% plus now, is because Shanghai was in a serious lockdown this time last year. So once we roll through that period where Shanghai was locked down, the period that we are comping or passing is a lot tougher. So I think towards the end of the year it's going to be meaningfully more tricky to print strong growth numbers. I think they can achieve it, but not without any action on the policy front. Yeah.
Nice to chat, Oyvinn. Good to have you on.
Pleasure to be here. Yeah, thank you.
Now, I prefer to avoid politics, but it's kind of relevant in this case. New Zealand's Prime Minister is in China this week. His visit is hot off the heels of US Secretary of State Antony Blinken, who made some comments about Taiwan while he was in Beijing. Take a listen to this.
We do not support Taiwan independence. We remain opposed to any unilateral changes to the status quo by either side. We continue to expect the peaceful resolution of cross-strait differences.
I thought this was worth mentioning because Taiwan is a critical place for the manufacturing of the world's semiconductor chips, including those that power AI. TSMC, the Taiwan semiconductor manufacturing company, is super tight with NVIDIA. For years, NVIDIA has relied on TSMC and its foundry capabilities to manufacture its chips. So I want to know if you invest in TSMC or China markets and stocks. Are they doing better or worse than you expected this year? Let me know. Now go and put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.